Let's get one thing straight right now. When you hear that the Federal Reserve did or did not change interest rates, that is not the rate you pay on a mortgage. This is Teri Graf with the Teri Graf Real Estate Team, here to help you understand what's really keeping the mortgage interest rates high. The rate everyone talks about on the news is the federal funds rate. Think of it as the interest rate banks charge each other for overnight loans. As of today, June 12, 2025, the Fed has been holding that rate steady. They are keeping it at what they call a restrictive level, meaning it's intentionally high to put the brakes on inflation and cool down the economy. They are trying to make borrowing more expensive across the board, and while that influences your mortgage, it doesn't directly set it. So, what is the Fed actually doing? Their main job is to manage the country's economic health, and their primary tools are controlling this key interest rate and managing their own investment portfolio, which we call their balance sheet. When inflation gets too hot, they raise rates to slow down spending. When the economy is weak, they lower rates to encourage borrowing and growth. In 2025, their foot is still firmly on the brake. They made some small cuts late last year, but since January, they've hit pause. They are watching the economy like a hawk, looking for signs that inflation is truly under control before they make any more moves. This creates a holding pattern of uncertainty for everyone. The connection between the Fed's actions and your home loan is indirect, like a ripple in a pond. The federal funds rate influences what banks pay for money, which in turn affects the rates they offer on things like credit cards, car loans, and home equity lines of credit. It sets a general tone for the entire financial market. A higher federal funds rate signals that the era of cheap money is over for now. This makes all forms of lending more expensive, and that sentiment trickles down and contributes to the overall environment in which your mortgage lender operates. But it is not a one-to-one relationship, and that is a critical distinction you must understand. This is why you cannot just watch the Fed's announcements and expect to predict where mortgage rates are headed. It's far more complicated than that. You have to look past the headlines and understand the deeper forces at play. The Fed might be the conductor of the economic orchestra, but they are not playing every instrument. When it comes to your mortgage, a completely different section of the market is calling the tune. Understanding this difference is the very first step toward making a smart, empowered decision about buying a home. It's about knowing what truly drives the numbers, so you can navigate the market with clarity and confidence, not fear. All right, if the Fed isn't setting your 30-year fixed mortgage rate, who is? The answer lies in the bond market. I want you to think about bonds as loans that investors make to governments or companies. When you buy a bond, you are paid back with interest over time. The interest rate on that bond is called its yield. Mortgage rates are most closely tied to the yield on a specific type of bond called a mortgage-backed security, or MBS. These are bundles of thousands of individual mortgages packaged together and sold to investors. The rate you are offered for your home loan is directly linked to the yield investors demand to buy these MBS packages. The other major player here is the 10-year Treasury note. This is a bond issued by the US government and is considered one of the safest investments in the world. Its yield is a benchmark for all sorts of loans, including mortgages. Lenders look at the 10-year Treasury yield and then add a certain amount on top of it to determine your mortgage rate. This extra amount is called the spread. The spread covers the lender's costs, their profit, and the extra risk they take on by lending to you instead of the super safe US government. So your mortgage rate is essentially the 10-year Treasury yield plus this spread. It's a simple formula with very complex drivers. So why does the demand for these mortgage bonds matter so much? It's simple supply and demand, my friends. When lots of investors want to buy MBS, the demand is high. To attract all those buyers, the bond issuers don't have to offer a very high yield. A lower yield for investors means a lower mortgage rate for you. But when investors are nervous and don't want to buy MBS, demand is low. To entice them to purchase these bonds, issuers have to offer a much higher, more attractive yield. That higher yield translates directly into the higher mortgage rate you see when you apply for a loan. It all comes down to how appealing these bonds are on any given day. This is where the Fed's actions come back into the picture, but in a different way. During the pandemic, the Fed was the biggest buyer of MBS, purchasing billions of dollars worth to keep demand high and push mortgage rates to historic lows. Now, they are doing the exact opposite. The Fed is shrinking its balance sheet, meaning it is no longer a major buyer in the MBS market. This has created a massive hole in demand that other investors have not been willing to fill, at least not at the old, low yields. This single action is one of the biggest reasons rates have remained stubbornly high, even when other parts of the economy seem to be improving. Let's look at the hard numbers as of today, because numbers do not lie. The yield on the 10-year Treasury note is hovering around 4.40%. But if you go to get a 30-year fixed-rate mortgage, you're looking at a rate of about 6.85%. That means the spread, the gap between those two numbers, is a whopping 2.45%. Historically, that spread is usually much smaller, often under 2%. This wide spread is the villain in our story right now. It is the reason your mortgage payment feels so much higher than you think it should be. The risk premium that lenders and investors are demanding is elevated, and you are the one paying for it every single month. So what is keeping this spread so wide and investor demand for mortgage bonds so low? It's a cocktail of economic uncertainty. First, there's lingering inflation. Even though it's down from its peak, it's sticky, and investors worry that it could erode the value of their bond returns over time. They demand a higher yield to compensate for that risk. Then there are concerns about the housing market itself and the overall economy. Any hint of a slowdown makes investors nervous about the possibility of homeowners defaulting on their loans, which makes mortgage bonds seem like a riskier bet. They want to be paid more to take on that perceived risk. Furthermore, the Federal Reserve's absence as a major buyer has fundamentally changed the market's psychology. Private investors, like pension funds and international buyers, are now the primary customers for MBS. These investors are far more sensitive to risk and price than the Fed was. They are carefully weighing MBS against other investment options, and if they can get a better, safer return elsewhere, they will. This forces bond issuers to keep yields high to compete for capital. Until these big money investors feel extremely confident about the future of the economy and inflation, they will continue to demand this extra premium, keeping the spread wide and your mortgage rate high. This is the reality of the market in mid-2025. We are caught between the Fed's fight against inflation and a nervous bond market that is demanding to be paid extra for taking on risk. While rates have thankfully stayed below 7% for a while now, they are a far cry from the sub-3% rates we saw just a few years ago. Wishing for those rates to return is not a strategy. Understanding why they are high, however, is. It gives you the power to stop waiting for a miracle and start looking for a smart path forward in the world as it is today, not as you wish it were. In a market this complicated and unforgiving, trying to go it alone is financial suicide. You would not perform surgery on yourself, so why would you try to navigate the biggest financial decision of your life without an expert? This is where a truly knowledgeable real estate team, like the Teri Graf real estate team, becomes your most valuable asset. They do more than just show you houses. They act as your financial strategist, your market interpreter, and your toughest negotiator. They can explain in plain English what is happening with mortgage bonds and how it impacts your specific purchasing power, turning confusing data into a clear action plan. Think about the practical advantages. An expert team has seen these cycles before. They know that in a high-rate environment, there are hidden opportunities. For instance, they have the negotiation prowess to ask for seller concessions. This could mean getting the seller to pay for a 2-1 buy-down, where your interest rate is lowered for the first 2 years of your loan, saving you thousands when cash is tightest. They also have established relationships with a network of trusted lenders. They can connect you with professionals who will shop for the best possible rate and terms, because even a 1/4 percentage point can mean a massive difference over 30 years. A great realtor also thinks creatively to get you into a home. The Teri Graf real estate team can identify properties that others might overlook, like a solid fixer-upper that could be perfect for an FHA 203K renovation loan, allowing you to wrap the cost of repairs into your mortgage. They might suggest looking at a slightly smaller home or a different neighborhood you hadn't considered, where your budget can go further. This isn't about settling. It's about making a smart, strategic move to start building equity now, instead of waiting on the sidelines while home prices continue to climb. You have to be smarter than the market. Ultimately, you cannot control the Federal Reserve or the global bond market. You can only control your own decisions. The key to winning in today's housing market is not about timing it perfectly. That is a fool's errand. It is about having the right information and the right guide to help you make the most powerful and approved choices for your financial future. With an expert like the Teri Graf real estate team in your corner, You are not just buying a house, you are making an informed, strategic investment in your future, armed with the confidence that you have the best possible advice leading you home. Now that is approved. Contact Teri Graf at 319-9811748 or go to terigraf.com.